Hello and welcome to ChooseFI. Today on the show, I have my good friend Sean Mullaney, the FI tax guy, here to join me to go through all the ways that we can access our retirement funds and really how we can bridge the gap between an early retirement and let's say 59 and a half, which is the age where we can access our retirement funds without a penalty. So there are a handful of ways, and we're going to really dive into each and every one of these. I think this is going to be fascinating, and I think this is really important for every single member of the FI community. With that, welcome to ChooseFI. Sean, my friend, thank you for being on the show. It's always good to see you.
Brad, excellent to be back.
Yeah, this should be fun. So, okay, let's try to set the stage together here because I suspect if I go through it, I'm going to miss a thing or two. But in essence, many of us contribute money to quote unquote retirement accounts, right? In the FI community, or at least as ChooseFI says it, it's control what you can control. And we like to really max out or certainly contribute significantly to our tax deferred retirement accounts. So think traditional IRAs, regular 401ks, where you get a tax deduction in the current year. And then you have to, when you pull that money out, it's a taxable event. And also, as I mentioned in the intro, most of these accounts have this random age of 59 and a half. That is when you can start accessing it without a penalty. Now, like I said, for most of these accounts, this will be a taxable event, and we can dive into that for sure. But in terms of just a conceptual framework for people, if they have money in these traditional accounts, okay, look, you got a tax deduction on the front side, you need to pay tax on the back side. And I think there's that aspect of it, but there's also this, hey, I might actually want to stop working before 59 and a half. I'm in the FI community. What do I do? How do I access this money? Is it locked there forever? How do I even think about this? So, Sean, is that a pretty good frame for where to start the conversation?
Yeah, I think, if you are 59 and a half or older, or you're thinking, I'm going to retire at 59 and a half or older, the tax rules in terms of distributions tend to be favorable to you regardless of your asset mix. Now, that's a different conversation about what the ideal asset mix is, but the tax rules tend to be relatively favorable regardless of the composition of your assets. All right. But a lot of people in the audience are in either of the following two boats, right? One boat is I'm in my 50s or even late 40s. I've got sufficient assets, but a lot of them are locked up in tax deferred accounts. I want to retire. I'm thinking about retire. How can I get there? And then second in the audience might be people in their 30s or 40s thinking, I'm going to be able to generate sufficient wealth to retire in my early to mid 50s. How would I go about drawing down those assets, right? What are the different tactics and buckets available to me so that I can retire and not be too concerned about that 10% early withdrawal penalty? By the way, for those who live in California, they add 2.5%. So
Really?
it's that much more onerous for me and my fellow Californians. But that's sort of the way I'd be thinking about this conversation is a lot of us want to retire in our 50s and have sufficient assets, at least on paper, to do so. But the tax rules, at least initially, put up a gate, a bar to doing that. So let's talk through the different tactics available to us to be able to fund our lives and potentially do some tax planning in our early to mid 50s when we're retired.
Okay, I love it. Let's start with what is probably the most obvious, though it sometimes gets forgotten in this conversation when we're looking for specific tactics and fun names. The most obvious is just, hey, do I have money in my taxable brokerage account, right? In my bank accounts. Is that really where people should start?
I think so, Brad. So in an ideal world, we would get to retirement before age 59 and a half, and we would have sufficient taxable assets to take us from retirement date to age 59 and a half date. There's so many reasons this makes a lot of sense. First of all, when we withdraw from taxable assets, we're withdrawing, generally speaking, two different things. We're withdrawing cash, right? There's no tax on the withdrawal of cash from your savings account. So that keeps our taxable income at zero. There's no tax, no penalty. We love that. But wait a minute, Sean, I don't want to have that much cash for a variety of reasons. We're not here to give investment advice, but there might be reasons you don't want to have a ton of cash. So, okay, I've got mutual funds, stocks, bonds, ETFs. Well, those have capital gains in them often, not always, but often. But even if they do, right? So let's say you had a mutual fund that's worth $10,000 that you want to liquidate for the next few months of your living expenses. Well, you probably have at least some so-called basis in that asset. So let's say it's $8,000. So going and spending that $10,000 doesn't increase your taxable income by $10,000. In that example, it only increases your income by $2,000. And oh, by the way, that's probably going to be long-term capital gain income, not ordinary income. So the federal tax rate on that might be zero. So when we spend down these taxable assets, we control our income, which is really good. Second thing we do is we reduce our future, what I refer to as uncontrolled income. Like, I love taxable assets, but they have a downside, right? Say you had $1 million in a portfolio of stocks. Well, that's going to generate some dividend income on your tax return every year. That's what I refer to as uncontrolled income. Well, isn't it nice to spend that down first so that, hey, we're not going to have as much uncontrolled income in the future, and then we can do more tax planning. So that's another advantage of spending down these first. And then the third thing is creditor protection. So creditor protection is a whole other conversation. But if we think about 401ks, IRAs, they have varying degrees of creditor protection that don't exist, generally speaking, for taxable brokerage accounts. So if we spend down our taxable assets first in early retirement and we just let those IRAs, 401ks ride, over time, those things tend to grow just based on market appreciation, interest, dividends, capital gains. So we're increasing the balance sheet, our personal balance sheet that has at least some creditor protection, and we're spending down those assets that don't have creditor protection. Now, most folks should be thinking about umbrella insurance, but putting that to the side, it's still good to belt and suspenders it. So for many reasons, ideally, if we can get to retirement with taxable assets being sufficient to fund retirement to age 59 and a half, that's ideal. That said, we don't have to be ideal, right? I think that's one thing, one of the messages of the ChooseFI podcast, I hope, is that not everything needs to be optimized, not everything needs to be ideal. So maybe we don't have that much. There are plenty of ways we could talk about that. Okay, maybe we don't have taxable assets that get us from retirement to 59 and a half. But ideally, at least in my opinion, taxable assets is sort of the initial go-to.
Yeah, I agree. I think that is clearly the ideal methodology here. It's the no-brainer version, right? We don't need to think. We don't need to do anything else. It's just, okay, we're in real good shape there. But that said, you just gave a lot of nuance. And I want to just dive into a little bit of this because I think it's really, really important. So you said in there that long-term cap gains could be zero. Now, let's give a little more specifics around that. So I guess for the sake of argument, let's assume we're not doing a case study here. And obviously, like you said, we're not giving tax or financial advice to anybody. This is not a real person. But let's just assume this person that we're talking about, they're 50 years old. And when they stop working, they truly stop working. They have no other earned income coming in. So assume that their regular income is essentially zero. Now, Sean, at that point, if they have long-term capital gains, and now, like you said, in that scenario, they were selling $10,000. So $10,000 then was transferred to their bank account, but $10,000 is not the taxable amount. It's not a $10,000 gain. In your example, they had an $8,000 basis, which is in very broad terms what they purchased it for. Okay. So in that case, they have a $2,000 gain, and we're saying long-term. So it's 1 year or more. And that then goes onto the tax return as $2,000 of income as a long-term cap gain. Now, most people think of long-term cap gains rate as 15%. I think, Sean, for high-income earners, it's 20% is my last recollection. But there is a significant instance where long-term cap gains can be 0%. And I think this person might fit into that scenario, right?
That's exactly right, Brad. So the way it works is we have progressive tax rates both on ordinary income. So ordinary income enjoys the 10% tax bracket, then the 12%, then the 22%, 24%, 32%, 35, 37%. So the more you make, the more tax you pay on the last dollar you made. Okay. Well, capital gains have a modified version of that progressive tax bracket system. And the funny thing is, it starts at zero. It's a 0% long-term capital gains rate if our total taxable income, when we add everything together, so all our long-term capital gains, all our qualified dividends, all this stuff, right? When we add interest income, working income, pensions, whatever it is, when we add that up and subtract the standard deduction, if we find, hey, we're still in the 12% or lower tax bracket, and I just went to Google for 2024, right? Because these things always change. But
Yeah.
if your taxable income is under 94,300 and you're married filing joint in the year 2024, you're in the 12% bracket or lower. Well, guess what? The capital gains in that are subject to a 0% tax bracket. It's really
Amazing.
just a great thing. And it really, look, this tax break was not designed for early retirees, but it's sort of the early retiree tax break, right? So what you could do is get to retirement and you're not generating income. And yet, well, you might generate a little interest income on your tax return, but you're generally not going to be generating a whole lot of income other than long-term capital gains because you're liquidating some assets and qualified dividend income. As long as you can keep your income, including the high standard deduction, in that 12% bracket or lower, the long-term capital gains get taxed at 0%. So you could be funding your life with a 0% capital gain asset. There might be a small state tax on that, depends on where you live, but that's still really good.
Yeah,
I
that's
got to pay
remarkable.
4% state income tax and that's it. A lot of us would be pretty happy with that outcome.
And Sean, that is taxable income, right? So that's after standard deduction and such.
That's exactly right. Yeah.
Wow. So, right, gross income, as most people think of it, for married filing joint, it would be another, I don't know what the standard is, 27,000 thereabouts for 2024.
2023 it was 20 I'm going to actually Google that while we're chatting because these things change every year. So it
Yeah, we're
looks
recording this at the beginning of a year, which is always dicey.
Yeah, so it's 29,200 for married
Wow.
filing joint. So think about that. You could make over $100,000 married filing joint, right? You're not
Yeah.
single, but married filing joint, you could sell capital gain assets, generate $100,000 of capital gains during the year. If that was your only income and it was all long term, you would pay zero tax on that, even though you reported gross income, let's say of 100,000 of capital gains, and then your taxable income is going to be more like 70,000 and a little change because of the standard deduction. But boy, that's pretty good. If that was your entire tax return, you'd have 100,000 of income, zero federal income tax. Now, most people tend to have at least a little ordinary income. There's some interest income from a bank account. There's a little bit of that gain that's short term, that sort of thing. But generally speaking, you could get pretty close to zero federal income tax with a six-figure gross income amount. That's amazing. But that reality does exist today.
Yeah, that's crazy. And like you said, in that example, that's $100,000 of capital gains. That's not the proceeds, right?
That's
Using
right.
your other
That's right.
example, it could be multiples of that, 400,000, 500,000. Now, naturally, you're probably not going to pull all that out in one year, but I mean, there might be some tax planning there around potentially doing that. So that's for another conversation, but it's interesting how this just layers on top of each other. So kind of going back to the original example, and then we'll move on because obviously we have a whole bunch of different tactics to talk about here, but it's important to lay the groundwork. So the person that we're talking about, so they are 50 years old, they have $0 of earned income. Basically, they just have to cover their life's expenses for that year from 50 to 51 in essence. And like you said, let's say their expenses are 50,000. So using that same rough estimate of, okay, for every $10,000 they're pulling out, they have $2,000 of capital gains. So again, this is just hypothetical. So we're going to say they actually need to get $50,000 of proceeds. So they're selling $50,000 of long-term cap gains. But again, using your example, they actually have a $10,000 long-term cap gain. Okay. Now,
Yes.
if we assume that's all they have, again, kind of putting logic aside, there's no interest, no nothing, whatever. They're going to pay $0 of tax on that. But they wouldn't stop there, right? So actually, at that point, they would have additional space to do Roth conversions that it would be advantageous to do that because they can potentially pull money out of traditional Roth accounts and basically say to the government, hey, here's a taxable event, tax me on it, tax me on it. But because they have a standard deduction and who knows what else they have, they might have child tax credits or something else. There's a way that they can start those Roth conversions early. Now, this is not to be confused with the Roth IRA conversion ladder, which we are going to talk about, but it does get a little bit close to there, right?
Absolutely, Brett. In your example, particularly if they're married, but even if that person was single and they only had $10,000 worth of long term capital gain income, almost certainly that person basically sort of needs to do Roth conversions at that point. And in fact, what's probably going to happen is if they do Roth conversions at a small amount, they'll probably pay zero tax even on those. The way the tax rules work is ordinary income, such as a Roth conversion, where we affirmatively move money from a traditional retirement account to a Roth account, like you're saying, telling the IRS this is taxable income, that is taxed first, usually against that standard deduction. So it might be that that's 0% taxed, and then our gain is still in the 12% or lower bracket. So that too could be 0% tax. So they may have an opportunity on the table where If they don't do a Roth conversion, they're passing up a zero tax Roth conversion. The other thing, and you talked about this with Cody Garrett in a recent episode, is ACA premium tax credit. They may need to generate income if they're on an Affordable Care Act plan. Maybe they're not. They could be on COBRA, TRICARE. There's some other things out there. But let's say they're on an Affordable Care Act plan. They need to keep their income above certain limits just to make sure that they remain eligible for a hefty premium tax credit. So yeah, Brad, that's the second piece of this is, all right, we get to retirement. What do we live off of? I would say the taxable assets first, so it's like, hey, that makes our income relatively modest. And then that opens the door for additional tax planning, which usually takes the form of the Roth conversion planning, whether it's a Roth conversion ladder or just simply, look, I got an opportunity here. I'm going to take advantage of it. And who knows when I'm going to take it out of the Roth IRA.
Yeah, and like you said, the standard deduction is $29,200 for joint filers in 2024. So worst case scenario, just total back of the envelope, no other planning, nothing else involved. You can convert $29,200 from your traditional money that went in with the tax deduction and has never been taxed. It can move to a Roth, then never be taxed again, convert to a Roth. But like I said, you put that 29.2 on the tax return and say, hey, please tax me on it. But oh, no, because you have this standard deduction, you actually pay $0 on it. So that's a remarkable superpower of just how we think about this in the FI community. And Sean, I mean, this is pretty advanced thinking, but it's actually pretty straightforward in the cosmic scheme of things, right?
I would say so. The one little piece of that, and this is a little piece of it, this is getting way down the road, is so in that example, if they're married, they have 10,000 long-term capital gain, 29.2 of Roth conversions, and that's it. They pay zero federal income tax. They might suffer just a little bit of a diminution, but it wouldn't be much at all. They would suffer a little bit of a diminution of their premium tax credit by getting, now they're well above the 100%, 138%, whatever the threshold is, depending on where you live, on qualification. Right? We want to have enough income to make sure we at least qualify for the premium tax credit. Then what happens is once we get above that, we start to lose just a little bit of that premium tax credit. So there might be on a little piece of the end of that Roth conversion. I'd have to think about some numbers, but maybe the last 10,000 of that Roth conversion would reduce our premium tax credit by anywhere from 10% to 15%. So there's like a little surtax there, but you might still say, well, that's still well worth it because you still get a huge premium tax credit and all that money is going to grow tax-free for the rest of your lives. So just a little bit of nuance there. But in that example, if we can do a Roth conversion against the standard deduction, even if we have just a little bit of a premium tax credit reduction, almost certainly that's going to be good tax planning.
Yeah, agreed. And that 100% or 138, what you just said, that's of the federal poverty line.
Yeah. So what you have to do is you have to make sure your income, and you have to look at your state. Your income has to be above a certain amount because based on the income tests, if your income is below a certain amount, you qualify under that state's rules for the state's version of Medicare, and that can kick you out of eligibility for a premium tax credit. So basically, all we're saying here, Brad, is if you're going to be early retired, just make sure you generate some modicum of income. This is one of the reasons I don't like having everything in Roth when we get to early retirement, because then we can't generate income other than going to work. So I want folks to always be able to pull the trigger on some level of Roth conversions. And it usually can be pretty modest. It doesn't have to be $100,000, right? That's not what I'm talking about here. You always want to be able to pull the trigger on at least some modest level of Roth conversions just to make sure you stay above the relevant poverty level threshold. And it depends on where you live and your household size. So that's a whole other conversation.
Yeah.
But for most people, it's not going to be that much income. But if we only had everything in Roths, that's not going to be a good outcome.
Yeah, Sean, I love that you mentioned it. It's really important. Just this nuance is important. But again, we've covered the high level. I think we've covered the minutia a little bit. Let's dive into some of the real specific tactics, because I think people are going to be listening and saying, okay, we've got all these different things. You guys spent the first 20 minutes on, all right, take it out of your taxable accounts. But that said, kind of jokes aside, that was really, really important. So I'm glad we did that. Where do we go next? Where would you think is the absolute first way people should think?
Okay, so if I was in my 50s, I'm going to retire or I am retired and I'm running out of taxable account money. The first place I would look to, and this isn't going to apply to everybody in the audience, but over the next few years, it's going to apply more and more and more, inherited retirement accounts. That is absolutely the second place I would look. We're going to have a huge wealth transfer in this country of money in old traditional IRAs, old Roth IRAs, from baby boomer generation to Gen X, Gen Y. This is coming, and folks don't know what to do. Oh my goodness, I inherited a $300,000 traditional IRA. What do I do? Well, one of the things that it could be is that could be your early retirement fund. Here's the thing. If you inherit under today's rules from a parent, you're an adult, you inherit from your parent, you're going to have two things to think about. One is a 10-year rule. You're going to have to empty that thing in 10 years. So you don't want to wait till year 10 and just empty it and have a huge tax time bomb, right? Your parents do not need to be the Rockefellers or Warren Buffett to have a $300,000 traditional IRA they leave you, right? That's still a relatively modest wealth American. But if you inherit that, say, and you only take a very little amount from in years 1 through 9, you could have $500,000 you have to empty in year 10. That's fully taxable. It's a tax time bomb. Why not live on that in early retirement? You never pay an early withdrawal penalty on an inherited retirement account, right? Unless it's a spousal and you put in your own name, that's a whole other conversation. But if we're inheriting from our parents, which is going to be a bunch of people in the audience, 100,000, 200,000, 300,000, a million in a traditional retirement account, that would be the second place I would look to fund an early retirement because one, it manages for a tax time bomb we might have anyway. And two, it'll never be subject to the early withdrawal penalty. I can inherit that in my 20s and I don't pay an early withdrawal penalty on a inherited retirement account withdrawal. So that would be the second place I look, are these inherited retirement accounts. And this may not apply to you today, but it's going to apply to a bunch of the people in the audience over the next decade.
Yeah, that's huge. So, okay, no penalty, which is great. But like you said, there's that 10-year rule. That's regardless of when you receive it. Like you said, if you're in your 20s, you still have to empty that thing within 10 years.
Yeah, now if you're a minor child, like there's some exceptions.
Right.
But what we're talking about is those who inherited in 2020 or later. So thinking about those who are going to retire in the next 10 years. Under the rules today, if you inherit from an adult parent and you're an adult, in the vast majority of cases, there's some exceptions for disability and things like that. But generally speaking, you're going to have to empty that thing in 10 years at a minimum, right? If your parent was taking RMDs, the IRS is taking the position you have to take RMDs too. That's a whole other conversation.
Okay.
But you may want to take more than the RMDs because of this 10-year time bomb issue at the end of it. Now, there's also inherited Roth IRAs. The nice thing about those is they never have the RMD unless you inherit from like an adult sibling. All right. But if you're inheriting, say, from your elderly parents, you can inherit their Roth IRA, have the 10-year rule, and then you just take out whenever you want. From a tax planning perspective, you want to leave it in for the 10 years just to get the maximum growth. But maybe you're at a point where, look, I'm out of taxable assets, I'm retired. We'll just take it from the inherited Roth IRA. That's okay. No tax, no penalty. You're good.
Okay, that is great. Sean, I'm going to ask you for a quick sidebar here. Now, obviously, we cannot spend we could probably do an entire episode on just this, but in just a minute or two, when people think about inheriting money, I think there's a lot of uncertainty over potential tax. So, as I understand it, and this is very broad, I'm going to paint the broad brush from my understanding. I'd love for you to fill in. All right, Sean, there is the estate tax exemption, which, and this is always subject to change, but I mean, it's something crazy like $13 million in change for a person.
13.61.
Yeah, right. And double that for a married couple. So for the vast majority of people, there's going to be no tax on estates. So the money passes to, let's say if, when my parents pass away, the money will pass to me tax free. But then, like you said, if it's in a traditional IRA account that has never been taxed, it will be a taxable event when I pull the money out. Now, what about if it's in a taxable brokerage account? Now, I am under the impression there's a step up in basis. So you get it essentially at the fair market value, and there's no then long-term or short-term capital gains built in. But I'd love to hear you fill in the blanks on this.
Yes. So you're absolutely right. Almost everyone in the audience will never encounter the estate tax, right? So we can, generally speaking, put that to the side. If you're going to encounter the estate tax, you ought to already have plenty of advisors in your life. Let's put it that way. All right. So then we think about the retirement accounts, traditional IRAs, Roth IRAs. The traditional IRAs, no step up in basis, always taxable, For those inheriting from their elderly parents, generally speaking, a 10-year rule applies, right? Roth IRAs, they don't get a step up basis, but they don't need it because it's tax-free distributions anyway. But then the taxable accounts, right? Step up in basis. I like to say some of the best tax planning is both free and inevitable. And that is the step up in basis. It's great to leave taxable brokerage accounts to your heirs because they inherit with the so-called step up in basis. So on the way home from the funeral, they can sell those assets, and there's the only capital gain would be from the date of your death to the date of your funeral, very little, right? So, that basically what happens is if you inherit a taxable brokerage account from your mom, your dad, that basically just goes into your taxable asset pile, and it only has capital gains from the date of death going forward. So that's a great asset to use to fund an early retirement.
Awesome. That was very helpful. Thank you for the sidebar. So let's keep rocking and rolling here. So inherited retirement accounts we've got. Where do we go next?
So the next place I would go if I was thinking about an early retirement is the so-called rule of 55. Folks in the FI community love the rule of 55, but it's somewhat constraining, right? So what this says is if I leave employer A and I do it in the year I turn 55 or later, I can take penalty-free withdrawals. I still got to pay the tax, but I never pay the 10% penalty on withdrawals from that employer's 401k. But we got to think about it. It's a little constraining, right? Because I have to separate from service in the year I turn 55 or later. So I can't do this in the year I turn 52, 53. And I can only get it from the 401k or other employer plan at that employer. So if I have another old 401k from a former employer, that doesn't qualify. And what if I don't like the investments at my current employer's 401k? Then that's not so good. And I can't roll my current employer's plan into an IRA before 59 and a half. The second I do that, I lose this exception too. Look, maybe I'm 56 years old and I'm going to retire and I've got $1 million in my employer 401k and I love my employer 401k. Then great. Rule of 55, great way. I pay the tax, but no problem. And then I don't have to pay the 10% early withdrawal penalty. I'm happy. So that would be one I would very much look into, understanding it's got some constraints, it's got some limitations.
Okay. So yeah, that sounds very limited because like you said, I think the majority, I'm making this stat up, but I would think a significant percentage of people who separate from an employer would roll that 401k into a traditional IRA that they control at an investment company that they work with already. Think Vanguard, Fidelity, Schwab, et cetera. So, right, those people, because it's not that employer's 401k, they can't do this. And so, right, rule of 55, this is if you separated from service at 55 or after. So we're talking at most, this is a 4.5 year gap to get us from 55 to 59 and a half, right? In best case.
Yeah, it has a slightly odd rule that you basically get to be 55 on January 1st of the year you turn 55. So it could be a little more than 4.5 years.
Right. But not much.
But anyway, so it's a powerful tool, but it's got to be the right profile, right? Yeah. It's not going to be for everybody out there. And you may decide, hey, you know what? I just don't like the investments inside this 401k. So I'm going to do a traditional IRA transfer. And then we could do other planning. We'll talk about that later. It just means that the rule of 55, which is flexible in the sense of, I love this 401k. I left after 55. Great. Then it's very flexible. You just take distributions however you want. Not that many limitations, but again, you have to have exactly the right profile to qualify.
Yeah. Okay, great. So let's not belabor that one. I think everybody understands, very specific, but can be really, really useful. So, okay, where do we go next?
The next place I'd go, again, for a limited slice of the audience, governmental 457Bs, right? So for whatever reason, the tax code never attached to governmental 457B plans the 10% early withdrawal penalty. So for those in the audience with the right kind of 457B, check with your employer, check with your plan administrator. This could be the path. And in fact, you probably wouldn't want to roll into a traditional IRA if you had this feature. This could be just a great way of avoiding the 10% early withdrawal penalty. We don't have to worry about age. We just take it. Yeah, we pay the tax, like I said, but no big deal. We avoid the penalty there, but you got to check with your employer to see if that particular 457B qualifies.
So, Sean, okay, that's an important point, right? Not every 457B qualifies, but it sounds like the majority of them would, right?
That's my understanding of it. I haven't actually encountered too much of that in my practice. The other thing to consider is sometimes people have rolled IRAs into 457Bs, and sometimes the withdrawal of that particular money doesn't qualify. So you just want to be very careful with that. I think the IRS has some literature around this. But yeah, I mean, it may be the case that the 457B is a great place to access penalty free distributions before 59 and a half.
All right. I love that. And so right, again, subject to you confirming that your 457B works for this, which it sounds like many should, but you obviously need to confirm. This means, right, there's no penalty before 59 and a half on any of these 457Bs that qualify.
That's
So
right.
it's not, hey, if you wanted to start accessing it at 35, you could. This is not like just get you from 50 to 59 and a half. There's no, you need to be in your 50s. This is just part of the 457B. And Sean, I'm so glad you mentioned this because I get emails every single time 457B comes up or any of these early withdrawal options come up because I almost invariably forget this. And people are like, Brad, you have to mention this every single time. It's so important. This is like one of those essential pieces that really people who have access, like you said, government employees, et cetera. This is a real positive aspect of 457B. So I'm glad we touched on that. All right. So we did taxable accounts, inherited retirement accounts, Rule of 55, 457B. What's next?
So, to my mind, we have two big ones left on the table. The first one is what I refer to as Roth basis. Often people talk about a version of Roth basis referred to as the Roth conversion ladder. So, the most natural application of this, but certainly not the only one, is say you get to early retirement at age 50 and you're like, hey, I like that taxable accounts thing Sean and Brad were talking about. So, what I did was I had 5 years of taxable accounts saved up and I live from 50 to 55 on those taxable accounts. But what about 55 to 59 and a half? And I separated from service, by the way, well before 55. So rule 55 is off the table. I don't have a 457B, right? So what could I do? What I could do is set up a situation where in my later 50s, I have what I refer to as Roth basis to withdraw from. So Roth basis is all your old annual contributions and Roth conversions, generally speaking, that are at least 5 years old. So a bunch of people are going to get to early retirement with Roth basis existing because, hey, in their 30s and 40s, they were contributing to Roth IRAs, hopefully in their 20s, right? But even if you didn't, what you could do is in those first few years of early retirement, you could do Roth conversions, say 40,000, 50,000, 60,000. You say that's going to be relatively low tax, but it also sets up basis that in 5 years I could take tax free, penalty free. And so that can be a strategy of, okay, I've got some taxable accounts. I have some Roth basis already. I'm going to generate more Roth basis by doing these affirmative taxable Roth conversions. In 5 years, if I'm under 59 and a half, in 5 years, I can access those old conversions without paying the 10% early withdrawal penalty.
Yeah. Okay. This is huge. And there is a distinction, right? So you're saying regular Roth contributions that you may have made over the years. Now, I know you've told us previously, we had a specific segment on this of how much you love the Roth IRA because your contributions, your standard contributions to Roth IRA can be withdrawn, obviously tax, but tax and penalty free at any point. So there is a distinction between the Roth contributions that you made over the years and this Roth IRA conversion amount. Is that right?
That's exactly right. So the Roth contributions, those annual contributions you made every year, when you're taking money out of a Roth IRA before turning 59 and a half, those come out first, tax and penalty free at any time for any reason. So a bunch of folks in the audience are actually going to have a significant amount of that. So you could take those out, and those, by the way, come out first. There's an ordering rule, right? We don't even get to decide this, but the ordering rule turns out to be very favorable for taxpayers. So, okay, great. Maybe you retire at 57 and you look at your old Roth, what I would call Roth basis, and you say, well, I've got 2.5 years of old annual contributions. I could just live off that in theory, right? It might be that you have just enough to get there. Or it might be you do Roth conversions in early retirement, but then, yeah, for the first year or 2 or 3, you live off your old annual contributions, and then you access those quote unquote ladders that you set up because you did 40,000 in year 1. Well, guess what? That'll be available in year 6 and later. So that's the big distinction is Roth annual contributions come out anytime, tax and penalty free, any reason. Taxable conversions, you gotta wait those 5 years, right? But if you have other Roth basis that works, maybe waiting that 5 years is no big deal.
Yeah. And I think the Roth IRA conversion ladder is one of the most powerful things we have going in the FI community. And Jonathan and I, way back when, in episode all the way back in 17R, Sean, which is April of 2017, literally
Wow.
almost 7 years ago. And then we followed up in January of 2020 in episode 163R. Those are two different Roth IRA conversion ladder case studies. Okay. So for anybody listening, if you were not a ChooseFI listener way back when, which most likely you weren't, go back and listen to those 17R and 163R. There's like probably 20 or 30-minute segment in each one. And it really dives through just an example of a case study because, again, this is what I think might be the biggest superpower of the FI community, where you can put money in to your 401k, traditional IRA, et cetera, tax deferred. So you got a tax deduction on the front side. And then, Sean, like we talked about 20 minutes ago, where because of the standard deduction and potentially other deductions, maybe tax credits that you might have, there's a reasonable chance that, especially if you're at a point where you have $0 of current income, that you could do this conversion and pay $0 of federal or close to $0 of federal tax on it. And then what you're ultimately doing is creating a 5-year bridge because, like you said, you can't access that amount that you converted until 5 years later. So what you need is your 5 years of living expenses in that intervening time. Now, most people will get that from regular taxable brokerage accounts. Like you said, you can pull it from other Roth contributions that you made, normal Roth contributions that you made from maybe 10, 20, 30 years. And that might cover you for a year, 2, 3, or maybe even up to 5 of those years that you need to bridge. But every single year you can do that Roth conversion, maybe pay $0 of federal tax or close to zero on it, and ultimately pull all or most of your money out of your taxable, quote unquote, taxable accounts like your 401k and IRA and pay $0 in tax on it. I mean, Sean, if that's not a superpower, I literally don't know what it is.
Yeah, it's really fantastic. I've been thinking lately, what does our tax code want us to be? And it feels like our tax code wants us to be retired, particularly early retired and married. I will say that married, the superpower is if you could be married and early retired, the tax code loves you, right? And this Roth conversion ladder, by the way, it still works very well for singles, but for marrieds in particular, boy, oh boy, can it be very powerful. And like you're saying, you basically, you're working, so you're paying marginal tax rate 24%, 32%, 35%. Okay, great. You take a deduction in a 401k, fantastic. And I save some tax this year. And then you get to early retirement and you could employ a tactic like this and it can come back out. Some of it's going to come back out at zero if you do things right. So you really made money on these traditional retirement accounts. It's fantastic planning. And it is a reason, if you're sort of teetering, should I early retire? Should I not? The tax code would like to weigh in and say you should. Now, that's not the only determining factor, but boy, oh boy, can it help for those thinking about early retirement.
Yeah. Yeah, I love it. It really, again, it's almost beside the point of how we want the world to be. It's irrelevant. I think this is where a lot of us get caught up in is like our ideals and how we want the world. Like the rules are the rules, and we have to maximize them to the extent that we can. Do I think that this was how this should be in a perfect world? Yeah, probably not. But listen, I'm going to take it. And it's the same with the ACA. I mean, that's another massive aspect of this is if your income is low enough, you're going to get essentially free health insurance or pretty darn close to it. So fully subsidized health insurance, let's say. So, like you said, you get to a point where you're like, all right, look, if I can get all this money out tax free, my tax liability is going to be almost zero. My health insurance premiums are going to be almost zero. I mean, it is really, you can make that case that this is set up to incentivize people to retire early and be in the FI community. I mean, we're being somewhat facetious, but not all that much,
I totally agree, Brad. And yeah, you don't make the rules. And, even if you ran for Congress, Brad, you'd be one of 435
Yeah.
in the House, right? One of 100 senators. So even if you were in Congress, you wouldn't have that much control over this. And most of us listening probably aren't in Congress, right? So it's not our fault the rules are what they are. They are what they are. We're just playing by these rules.
Yep. Agreed. All right. We're getting towards the end here. I think there's one more massive one that you want to talk about.
Yeah, and it's something that has changed recently. And it's a change that a lot of folks didn't fully appreciate, myself included, when it happened. So it's the 72T. So 72T was something a lot of planners were wary of for a variety of reasons. It's more complicated than anything else we've talked about so far. But the other thing about 72T before January of 2022 was this: it was very dependent on interest rates. So if your plan in your late 30s, early 40s was, I'm going to get into my early 50s and retire in a 72T, you were taking a big gamble. You were saying, all right, I think interest rates will be high enough to support an annual payment computation that will get me enough to live off in retirement, right? 72T is basically a computational thing. I've done a blog post about it. I've done a YouTube about it. I can send that to you, Brad, for the show notes.
Yeah, we'll link that up in the show notes for sure.
It's not that complicated, but it very much relies on having an interest rate that could support pulling out a set amount from traditional retirement accounts that could support you in retirement. And if interest rates went really low, that was going to be very hard to do unless you had a massive amount inside traditional retirement accounts. Well, January 2022 happens. The IRS and Treasury sort of quietly issued a notice. It's called 2022-6. And this notice says, well, you can always use a prevailing interest rate based on market conditions. They call it 120% of the midterm applicable federal rate. Okay, fine. But that's based on market conditions, or any interest rate from 0 to 5%. Basically, it says if interest rates go to 1%, 0.5% lower, you can always use up to 5%. Well, that made 72T a lot more reliable. Doesn't mean it's a go-to, but I'm telling you right now, Brad, there are people listening to this today who are 52 years old, 53 years old. They've got $10,000 in a savings account. They've got a paid off house, and they have 2 to 3 million in a 401k or other workplace retirement plan, all traditional. And they're saying, well, I have enough money to live off in my retirement, but it's all subject to that 10% early withdrawal penalty. And I would tell that person, now is the time to at least reassess, to say, you know what, I know 72T's out there. I know it requires some knowledge, and it might even require working with a professional, but I can get educated about it, and it's not so onerous. What it means is you're generally signing up to do an annual equal payment between now and turning 59 and a half. If we're 54 and a half or younger, we're doing it for 5 years, right? You have to do it for at least 5 years. So if we're 50, it's to 59 and a half. If we're 56, it's to 61. 72T is out there. I don't think it's the go-to because it has bells and whistles. It has some constraints. We have to take that money out every year. If we don't, we get assessed the 10% penalty on the earlier distributions we did under 72T. So it's not likely to be done. If I'm at 30 years old in the audience right now, I'm probably not going to plan into 72T, but I'll tell you, if I'm 51, 52, 53, I'm listening to this now, I look at my sum total and I say I have more than enough to retire, but 90% of it's locked up in tax-deferred 401ks or other assets. I'd say, I want to at least consider this. I want to think about it if I'm thinking about retiring.
Okay. That is very, very helpful. So, right, this is for, in very broad terms, like you said, somebody who doesn't have, let's say, a large taxable account to fall back on to maybe bridge the gap, like we talked about with earlier, different options.
Yeah, this is for, I can't rely on rule of 55. Maybe I'm 52, 53. I don't have an inherited retirement account on the table. I don't have much in the way of Roth basis, and I want to leave now, right? The Roth basis, maybe I have 20,000 of Roth basis. Well, that's only going to take me so far, and then I got to do Roth conversion ladders, right? If I don't have all these other tools in my toolbox, rule of 72, to my mind, seems to be something that in today's revised environment, with the ability to use the 5% interest rate, I could probably, what I'm trying to do with a 72T is set up 2 IRAs. It's sort of interesting. I set up 2 IRAs. I set up a 72T IRA. That's the IRA that I lock up and I take out the annual payment every year. But I always want to have a non-72T IRA if I can, for 2 main reasons. One, I may want to do Roth conversions from that thing, right, in addition to the 72T, but that's a marginal reason, but that absolutely could be a reason. The second reason is, what if I start a 72T at age 52 and I get to 57 saying, I'm like, I need some more living expenses. I can do a second 72T to supplement, well, there's been some inflation, or I want to buy a new car or whatever it is. I could maybe do a second 72T from my non-72T IRA. So it gets a little complicated. I did a lengthy blog post about it, but I think for those in the audience who are thinking about this and they go to their advisor, they may want to talk to their advisor, say, I think the planning environment on this changed because of this interest rate change from the IRS, and have a conversation that way.
Interesting. Okay. Since you brought that up, I can't let it slide. The splitting between IRAs, like again, we're not diving into like the precise details, the minutia of it, but what are you talking about there? Like, how would
Yeah.
someone literally split an IRA? Is it from a 401k? Is it like,
Yeah. So, generally speaking, what happens is this: if you want to start a 72T, you generally get your IRAs sort of all together in one IRA. And then you run some numbers in terms of what the 72T payout would be. And you'd say, well, I don't want that much, right? You'd run the numbers based on your life expectancy,
yeah,
the balance in the IRA, and the interest rate. And it would probably, in many cases, going to produce a number that's too high, right? Because you don't want to take 140,000 if you only need 60,000, because you don't want to pay tax every year on 140,000. So say you run the numbers on your total IRA, and it would produce an annual payment based on the IRS computation of about 140,000. But you say, well, wait a minute, I only want a $60,000 payment. So then what you do is you say, well, I got to compute something that would produce a $60,000 payment. So you figure out the size of what I refer to as the 72T IRA. And then you call your financial institution and you say, look, financial institution, I'm doing a 72T. And so I need you to break my current IRA with you guys into two IRAs. One is exactly the size of the 72T IRA, and then the other is whatever's left over. All right. And part of the reason I do that, well, I do that for a number of reasons. One, to control the size of the annual distribution. Like I said, I don't want to pay tax on 140 if I can pay tax on 60 and live on 60, right? And then two, that leaves me with a non-locked up IRA, this non-72T IRA. That IRA now can support all sorts of planning. Maybe that IRA I use for Roth conversions, if that's helpful. Or maybe that IRA I use later on to break up again into a second 72T IRA, because maybe my living expenses increase later. The other thing that's on the table here, Brad, since we're doing a 72T deep dive, is maybe I start a 72T at $60,000 a year at 52. Okay, fine. Well, then at 57, something happens in my life. I inherit a big IRA or other taxable account. My YouTube channel explodes, whatever it is, right? Now I have all this other money, but I still got to pay tax on this $60,000 every year. That's no bueno, right?
yeah, yeah,
Well, the rules allow you a one-time semi do-over. They allow you to recompute the 60,000 one time only, and basically you're able to hive that down based on a RMD table. So that's another reason to have our 72T IRA be as small as possible. If I need the bailout, just because, look, my circumstances changed, I don't need to be paying tax on $60,000. What you can do is you could say, all right, IRS, I'm recomputing how I compute this, and it's probably going to be a lot less than the 60,000. It won't be zero, but depending on your age and you want that account balance to be as small as possible at that point, so that the reduction becomes a lot less. So it's a semi bailout from, I agreed every year I'm going to take $60,000, but now I don't need 60,000. I don't want to pay tax on it. Well, maybe I check the relevant RMD tables. Maybe I can get that down to 15,000 a year. At least this year, I got to recompute it every year. But that's a semi bailout. And it's good to then have two different IRAs, because keeping our 72T IRA as small as possible can actually be beneficial if our circumstances change.
yeah. Man, Sean, it takes a lot to surprise me at this point. We've done 630 some odd episodes. I have never heard that. And I don't think, I would venture to say maybe less than a tenth of 1% of people in the FI community has ever heard what you just said, which is essentially, as I'm hearing it, you can split IRA accounts by your financial institution into, it sounds like essentially as many times as you want to. And these 72T, which are also known as what's the other
Series of substantially equal periodic payments, or
it's periodic payments.
SEPP or SOEPP. Yeah.
Right. So if you've heard it multiple ways, but those are IRA account by IRA account. So it sounds like when you are calculating this, it is just based on the amount in that particular IRA. And like you're saying, there's a lot of potential planning. You can subdivide these into small amounts for potentially, hey, I might need more in the future. Okay, I can subdivide it in the future. I can do it now, but it probably would make sense to do in the future. You split it into, hey, what do I need now? You calculate that, you leave that amount in, the rest you split into another IRA, and you have planning options for the future. So, I mean, Sean, that's brilliant.
Yeah, and actually on my blog, I did a post with a little bit of a case study where you start a 72T IRA and then later on you decide you need a little more. So I set up a second 72T IRA in the case study. And I think you alluded to, well, why haven't I heard about this until today? And some of it has to do with the history of 72T, where before this change in early 2022, you were taking a gamble. You were taking a gamble that interest rates would be high enough that it could support a sufficient payment. And back in 2020, interest rates got real low. I think one time the 120% of federal midterm AFR was something like 0.42%. So you'd have to have a massive IRA to support a payment that could sustain your lifestyle. So I think planners naturally sort of avoided them. And it was like, break in case of emergency. And now it's like, well, we could at least think about this a lot more, understanding that if we're a year or two out, we can at least plan, understanding we can always use at least a 5% interest rate. So this is one of those things where there was like this little mini earthquake in the planning world that so many of us, people are busy and we were in the habit of not planning into 72T. And I'm not here to say that 72T is now, the cat's meow, but I am here to say from a planning perspective, it became a lot more viable.
Yeah. Agreed. And I've always heard it's so complex and blah, 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 blah. So, yeah, it seems like there was a lot of talk against 72T, but we're hearing it now. Like my brain is now spinning because this is the first time I've heard of this. So I'm wondering, like, is that do over? You get that one do over, you said, essentially.
Yes.
Is that by account? So let's say, what if you had set up 10 different, I'm not arguing for this, your brain's going to explode, but you had 10 different of these split IRAs into little 72Ts. Do you get a do over per account, or is it just one per taxpayer?
Brad, it's all account by account. So it's funny that in the IRA world and the Roth IRA world, we tend to think about aggregation. Generally speaking, what the IRS says, the Internal Revenue Code just says this, is all your IRAs are a single IRA, all your Roth IRAs are a single IRA, a Roth IRA, all your distributions are a single distribution, the whole bit. Aggregation tends to be the rule of the land when it comes to IRAs. 72T is the exact opposite. 72T is IRA by IRA, just the way it is, right? So, you could in theory set up a 72T and then say, oh, I want to set up a second 72T IRA, and then say, well, I want to reduce the 72T payment from the first 72T IRA, but not the second. Yeah, it's account by account.
This is unbelievable. So, okay, I know you were giving the example of, okay, somebody who's about 50 or thereabouts, you should think about 72T, but are there any rules against someone younger doing it? I understand you're obviously locking in for a longer period of time, et cetera, but are there rules against that?
So, a couple things about a younger person using a 72T. First of all, it's often based on our age. So, the younger we are when we start a 72T, it's going to be harder to generate a sufficient payment to support our full lifestyle, right? So, that is an argument against somebody in their 30s or early 40s using a 72T. The second thing is 72T becomes more attractive the older we are, the closer we are to that 59 and a half because of the risk profile. So one of the risks on 72T is if we don't take out the payment every year, right? It's what I refer to as an execution risk, right? With proper planning, it can be mitigated and avoided. But say you drop the ball and you take out the wrong payment one year, well, that now subjects all the previous pre-age 59 and a half payments to that 10% early withdrawal penalty plus interest. So this is part of the reason we have to be careful. Like I'm saying, 72T is not the go-to, right? Even today, it's just more viable than it was 2 years ago. I think that's the big takeaway is, look, it's a more viable option. If we're sitting there in our early 50s and we have all this money, but it's all locked up, we ought to be thinking about it, but it doesn't mean it's risk-free. And if we are on a 72T, say it starting at 57 and we only have 5 years, and at age 60, we blow one of the payments, well, okay, we have the age 57, 58, and 59 payments that will now become subject to the 10% early withdrawal penalty and an interest charge. Well, that's one risk profile. But what if we started this at 48 and then we blow the age 58 payment? Now we have 10 payments or whatever that is, 11 payments that could now be subject to the early withdrawal penalty plus interest. So the older we are, the less risk a 72T payment plan presents. It's never zero risk. But to my mind, I feel like this risk is manageable. But yeah, you might need to consult with a professional on it.
Yeah, agreed. Okay, so execution risk, also known as maybe like dotting I's and crossing T's risk, right? Like if you're
Yes.
on top of things, if you have, like I use Todoist as my task list and I would have it in there precisely on the right date, I'm not going to miss this. But if you are, there's potentially a significant downside. But if you could say, I mean, again, my brain is just whirring 1,000 miles an hour right now, Sean, because this is an option that I had never considered, but I think is, with those caveats, is really, really viable for a lot of people. This is going to blow a lot of people's minds. So, okay, that was fantastic. I think basically the only way that I see left is just simply paying the penalty, as kind of not sexy or ideal as that is. Are we missing anything else, or is just simply paying the penalty before 59 and a half our last option?
I think that is the last option. I was telling you, Brad, before we started recording, I was thinking, what if I was 59 years old and I got 10 million in a 401k, an extreme example, and I need 40,000 for the next, 6 months. I'd probably just say, you know what? I'm going to pay a $4,000 penalty. I'm worth $10 million. I'm going to move on with my life. I'm not setting up a 72T. I'm not worried too much about, do I have enough Roth basis? Fine, right? But outside of that, yeah, and by the way, paying the penalty, it is 10%. You got to do your own analysis and research. And now the other thing too is, maybe it's like, look, I have a 1 year situation, right? Where I think maybe I'm going to take a mini retirement. Jillian Johnsrud talks about mini retirements. Maybe I need 20,000, 30,000 for the mini retirement. Then I'm going to come back to work. Would it be the end of the world to pay a $2,000, $30,000, 10% penalty on those type of amounts? I'd say maybe that's just a cost of doing business and you move on with your life. So paying the penalty is not the worst thing in the world. But I think part of the point of this conversation is, in today's environment, there are plenty of ways that you can live prior to 59 and a half without paying a 10% early withdrawal penalty.
Yep, totally agreed. That's what we talked about for an hour. So, yeah, there's clearly a lot of options. But again, this is not the worst option. And all the things that we talked about previously also tie in, which is, hey, this will be a taxable event, pulling that money out, right? But if you are earning $0 of income otherwise, like you're saying in this mini retirement example, you're going to pay potentially $0 of tax because of that standard deduction, et cetera, on that withdrawal. So you're paying zero, and then you have to pay a 10% penalty. I know it's not a tax, but even if we wanted to be cute and call it a 10% effective tax rate, listen, that's not so bad in the cosmic scheme of things, especially if on the front side, you got a deduction at 22, 24%, maybe 32, or who knows, right? Like, all right, listen, 10%, that still works out to be, this was a pretty darn good decision to do this. So yeah, even in kind of a worst case scenario, if you will, 10% isn't so bad. So it's just yet another thing to consider in this list. So Sean, this was a remarkable episode. Thank you so very much for being here. Thanks for dialing through all of these. I think we had, by my count, 6 different options is what I'm counting.
And then just diving into the penalties, option number 7.
Yeah, right. So 7 different options for accessing this money and really bridging that time to this mythical 59 and a half that we all kind of worry about. So Sean, again, thank you very much. As we've said, fitaxguy.com. I know people can reach you there. Is there another place you want to send people to get in touch?
So, Brad, folks can find me at my financial planning firm, MullaneyFinancial.com. You can find me on X at Sean Money and Tax, and you can find me on YouTube, Sean Mullaney Videos.
Beautiful. Sean, thank you again. I really appreciate your time. This was fantastic, and we'll talk soon. I know we have a mailbag episode coming up in the next couple of months, so that should be fun.
Thank you, Brad. Really enjoyed the conversation today.